Welcome back to the channel. Today we're diving into the top 5 investing mistakes and how you can avoid them to ensure your financial success. These are the mistakes I see people making all the time, and they can really cost you in the long run. But the good news is they're all completely avoidable with a little bit of knowledge and planning. So whether you're just starting out in investing, or you've been doing it for a while, this video is for you. Let's get started. The biggest mistake I see people make is investing without a clear strategy. They jump into the market hoping to make quick gains, but without a roadmap, they often end up lost and frustrated. It's like setting out on a road trip without a map or GPS. Imagine driving through unfamiliar territory with no sense of direction. You might take wrong turns, hit dead ends, or even run out of gas. You might eventually get to your destination, but you'll probably waste a lot of time and money along the way. The same goes for investing without a plan. You could end up making costly mistakes, missing out on opportunities, and feeling overwhelmed by market volatility. Before you even think about buying a single stock, you need to define your financial goals. What are you trying to achieve with your investments? Are you looking to build wealth over the long term, or are you aiming for short-term gains? Are you investing for retirement? This is a common goal for many people, and it requires a specific strategy to ensure you have enough money to live comfortably in your golden years. A down payment on a house, your kids' education, these are significant financial milestones that require careful planning and disciplined saving. Once you know what you're aiming for, you can start to develop a plan to get there. This involves setting clear, achievable goals and outlining the steps you need to take to reach them. This means figuring out things like your time horizon, risk tolerance, and asset allocation. Your time horizon is the length of time you expect to hold an investment before you need the money. Your risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Trust me, taking the time to create a solid investment strategy is the most important thing you can do to achieve your financial goals. It provides a clear path to follow, helps you stay focused, and increases your chances of success. So don't skip this crucial step. Plan wisely, invest smartly, and watch your financial dreams come true. Diversification. It's not the most exciting word in the world, but it's absolutely crucial for any investor. Think of it like this. If you put all your money into one stock and that stock plummets, you're in big trouble. But if you spread your investments across different asset classes, sectors, and geographies, you're much better protected from losses. This doesn't mean you need to invest in hundreds of different things. A well-diversified portfolio can be as simple as a few low-cost index funds. The key is to avoid putting all your eggs in one basket. Chapter 3. Mistake number 3. Emotions are not your friend. We've all been there. The market can be a roller coaster of emotions, and it's easy to get caught up in the highs and lows. The market takes a dip, and you panic, selling off your investments at a loss. This is a common reaction, but it's driven by fear rather than logic. Or you get caught up in the hype of a hot new stock and buy in at the worst possible time. This is often driven by greed and the fear of missing out. Emotional investing is a surefire way to sabotage your returns. When emotions take over, rational decision-making goes out the window. When you let your emotions dictate your investment decisions, you're essentially letting fear and greed take the wheel. Fear can make you sell too soon, while greed can make you buy too late. And trust me, that's not a recipe for success. Successful investors know how to keep their emotions in check and stick to their strategy. Instead of reacting emotionally to market fluctuations, stick to your investment plan. A well-thought-out plan can help you navigate the ups and downs of the market. Remember, the market goes up and down in the short term, but over the long term, it has always trended upwards. Patience and discipline are key to long-term investment success. Diversifying your investments can also help mitigate emotional reactions. By spreading your investments across different assets, you reduce the risk of any single investment impacting your overall portfolio. So take a deep breath, stay calm, and remember that emotional decisions rarely lead to financial success. Stick to your plan, stay informed, and keep your emotions in check. Chapter 4. Mistake number 4. Those pesky fees add up. You might not think much of a 1% management fee here or a $10 trading commission there, but those fees can really eat into your returns over time. Imagine you have a portfolio that you've been diligently contributing to for years. Every time you make a trade, there's a small commission fee. It might seem insignificant at first, but over time, these fees accumulate and can significantly reduce your overall returns. Let's say you have $100,000 invested and you're paying a 1% annual fee. That's $1,000 right off the top. Now think about this. If your investments grow by 5% in a year, but you're paying 1% in fees, your net growth is only 4%. Over 30 years, that 1% fee could cost you tens of thousands of dollars in lost returns. The impact is even more pronounced when you consider the power of compounding. Every dollar paid in fees is a dollar that's not compounding and growing over time. The good news is, there are plenty of low-cost investment options available, such as index funds and ETFs. These options often have much lower fees compared to actively managed funds. By minimizing your fees, you can keep more of your hard-earned money working for you. This means more money in your pocket and a more secure financial future. So always be mindful of the fees you're paying and look for ways to reduce them. Chapter 5. Mistake number 5. Stop trying to time the market. If I had $1 for every time someone asked me when the best time to buy or sell a stock was, I'd be writing this script from my private island. The truth is, no one can predict the market with 100% certainty. Even the so-called experts get it wrong all the time. Trying to time the market is like trying to catch a falling knife. You're more likely to get hurt than you are to make money. Instead of trying to outsmart the market, focus on what you can control: your savings rate, your investment strategy, and your emotions. Avoid these mistakes and start investing the right way. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more investing tips. Leave a comment below with any questions or topics you'd like us to cover next. Remember, investing doesn't have to be complicated or scary. By avoiding these common mistakes and following these simple tips, you can set yourself up for financial success.